All right, so I'm just going to, today I'll be giving sort of an overview of the taxation of various kinds of funds, mostly in a partnership form, although I'll just sort of gesture to the other forms that you could be doing. So I'm going to begin by just sort of letting you know the entities I'm not going to cover, then why you should know this area, what sort of funds we're talking about. As Roger indicated, this is venture capital. We'll talk a little bit about hedge funds, just a variety of funds at a high level, just to sort of let you know the tax structuring concerns. Then we'll go over sort of the structure of funds, and then the real keys, I think, the interesting parts of fund taxation, which is structuring for different types of investors and for different kinds of investments. So again, this is going to be focused on basically partnerships. That's all I'm going to be really talking about today. For certain kinds of funds, you're going to want to do conduit corporations. That is, regulated investment companies, real estate investment trusts. They have the favorable trait of being not a flow-through, so very simple for investors, but also still having one layer of tax. They have very narrow qualities in order to get them, so they're a little harder to qualify for, but if you can use them, they're often a great solution. But not what we're going to be talking about. So this is an area that I think it's a fun area to plan for, one of the more interesting areas of tax law, and also we happen to be in a place where it's very relevant knowledge. This is the venture capital, if you will, of the world, and we've got quite a variety of funds. I'm actually seeing some lending funds appear more and more often, which is sort of an interesting variety of funds in general. And long term, I think we're going to see I think it'll be an interesting space. We've got a lot of financial technology startups, which are already doing some interesting things in this area. For instance, you guys may have heard of, I always forget what it stands for. I think it's like a Decentralized Autonomous Organization, or the DAO. It was this, or it still is, a fund that was basically run through computers, through like the group vote of all the members. It sort of went disastrously wrong. It kind of got a little hacked. But at any rate, I think we'll see a lot more interesting stuff despite that sort of non-fortuitous start to new kinds of funds and new management structures. So this is just sort of the types of funds that you end up working with in this area. This is the taxonomy I chose. You can sort of split it up a little differently to your tastes. But I think this is more or less what people agree to. So these are the four types of funds, the way I think about it. There's the lower cash flow funds to the higher cash flow funds that also have a higher liquidity. By cash flow, I just mean that they have more constant cash, as opposed to a lot of bunching, which you have with private equity, for instance. In terms of liquidity, I mean how easy it is to get out of the fund. These ones on the right will tend to have regular withdrawal periods. In a private equity and a real estate fund, you're often pretty stuck until they let you out. So what are the differences among these different kinds of funds? Well, private equity fund on the far left, that's really what we're familiar with from VC, or VC being a subset of private equity funds. By private equity, I mean just any sort of fund that long-term holds securities in businesses that have quick growth potential for whatever reason, and it's typically an equity investment. VC, of course, it's a subset that will, take smaller positions, and a lot of startups that have a lot of growth potential. You've got leveraged buyouts, which, they look for businesses that they think have a lot of growth potential, and they use debt to magnify their returns very quickly. And you have your distressed funds as well. Also common are real estate funds. It's almost wrong to call them funds. They're just so key to what partnerships have been over the years. Partnerships have been a very traditional real estate investment vehicle. So in some ways, it just goes almost to the core of what a partnership is for tax purposes. Moving to the right into the higher cash flow funds, we've got our hedge funds. These are kind of an interesting set of funds, and there's not really a whole lot uniting them. They are often more short-term, more speculative investments, and the entire idea is to find mispricing, whatever that is, some sort of arbitrage opportunity. Sometimes they'll see a market's wrong. Sometimes they'll just see, they'll think some equity is mispriced, so they'll short it or they'll long it. And it's sort of a variety of approaches. And In terms of, again, their management structure, I think it's really their unifying feature, and that's, a very liquid fund, very easy to get out of, well, fairly easy. You can usually get out quarterly, and that's the big difference there. Lending funds are a subset of hedge funds. They make money by lending money, exactly like you would expect. They exist because there are just some places where either they think that banks aren't doing a good job of lending, or that they don't think banks are serving for whatever reason. So now we're going to move on to sort of the basic structure of the funds themselves and how they're structured to be tax efficient for the sponsors. So the main fund entity, which is the one I've helpfully labeled fund right here, is a partnership. It's going to be a limited partnership or an LLC. It's generally going to be Delaware or Cayman, depending on where the sponsor is, and sometimes who the investors are, because there's going to be some different reporting requirements, and it itself will hold the investments. For foreign funds, do remember that you're going to have FATCA reporting responsibilities. You're going to have CRS you're going to have to think about CRS no matter what, although the U.S. is not complying with the CRS reporting system, and you're going to have to think about money laundering for your investors. I just want to note that up front, just so I don't note it again later. Just get it out of the way now, because reporting is, not the most fun part of tax planning, in my opinion. Maybe you have differing ones. Moving on from there, we're going to talk about the sponsors. The sponsors are going to be the actual brains of the fund. They're the ones who come up with the investment strategy for the fund, and they're going to pursue it. Typically, they're going to have two separate entities that they're going to be interacting with the fund with. The GP, the general partner, is going to be the one that's going to take the carry, going to take the profits interest. For those of you who don't know, the main way that we do compensation for funds is we're going to have that carry, which is going to get a 20% or so profits interest from the company, and then they're going to have this management entity, which is going to be paid a management fee, which is going to be a percent of the value of the assets of the fund. I'll discuss in a moment. There's actually there's a lot of interesting tax planning you can do with those two structures. Last but not least are the actual customers of the fund, which are the investors, the limited partners. These are going to be, again, where a lot of the tax planning is. They are in very different tax regimes. You've got your tax-exempts, you've got your foreign investors, you've got your U.S. investors, and actually a couple other types. And each of them have their own tax preferences, which you have to consider as someone who's setting up a fund. To back up for a bit, I'm going to discuss what the sponsors care about from a tax perspective. Again, the sponsor is going to have this GP entity that's going to be a passive entity that's just going to hold the carry, and they're going to have the management entity, which is just going to take a fee for actually doing the job of managing the fund. The carry is just a partnership interest for tax purposes. So it's going to carry through the income character of whatever happens at the fund level. So if you sell capital gains assets, you're going to get capital gains up to the GP level. And that is usually a very nice aspect of being a fund manager. It's, all over the news, which I'm sure you guys see. It's probably the number one thing I hear about in tax policy from the news, that they want to somehow stop this. But pretty much every way that they figure out of trying to fix the problem just kind of really messes up partnership taxation, to my mind. But, that's for another day. So mostly this is advantageous to the GP, or to the sponsors, just because it gets them a better income character. But it also has some advantages to the investors. Allocations are a little bit nicer than deductions. They're just not going to run into any limitations really in allocations. When you get more complex structures, if you're relying on a carry, you need to just place your partnerships appropriately in the structure to make sure you're getting them an efficient tax return and also not double dipping. So there's two generally in most funds, the carry is the nicest aspect of the compensation. It's going to be getting off in capital gains rates. The management fee is going to be stuck getting ordinary income rates. But that isn't always the case. Again, we've discussed, as I mentioned, lending funds exist. these are going to be getting interest, right? That's going to be their main form of income, and that's going to be taxed at ordinary income rates. Hedge funds also will get a lot of ordinary income or ordinary income rates, since they'll be trading at a fairly rapid clip. So we end up on certain funds maybe not wanting to do a carry, which is which is something that not everyone thinks about. But nonetheless, state and local tax issues generally favor a carry. A management fee is going to be subject to local tax in the place where the business is operated. So in San Francisco, where you'll see a fair amount of funds, or in New York City, they're going to definitely be subject to some sort of local tax on the management portion. And for the carry portion, since this is not associated with a business, you can often get out of the local taxation through structuring through this. On the other hand, the management fee has the advantage of being able to, if you structure correctly, it can avoid self-employment and net investment income tax. If you're going to have to run into one, self-employment's a little bit better because you can deduct it partly. But here's sort of the overview of what you need to think about to avoid both the self-employment tax and the net investment income tax. It's very easy to plan out of the self-employment tax and net investment income tax, as I'm sure most of you know. For an S corporation, there's more uncertainty in the area of a limited partnership, but basically if you're an S corporation shareholder whose materially participates, you're going to get out of the net investment income tax or distributions, yeah, you are. And then you're also going to get out of your self-employment tax no matter what, as the distributions from an S corporation are exempt from self-employment tax. You do have to pay a reasonable salary, of course. As for limited partnerships, a limited partner is exempt from self-employment tax on the distributions. There is quite a bit of uncertainty what the term limited partner means, though. So you can plan with it in your partnerships to try and avoid self-employment tax, but it's a little bit at your own peril. But nonetheless, people do seem to agree it's possible. You just need an active limited partner, not really a management kind of person, and you can do it. So from there, we'll move on to, one of the two real cornerstones of, I guess three cornerstones of planning for funds. The first being that the sponsor planning I just discussed. Next, we're going to discuss the structuring for your different investors. This is just sort of an overview of your five sort of main investor categories and what they care about. What sort of issues for them are going to come to the forefront of your tax planning, and which, if you don't consider it, you might annoy them a little bit. A U.S. taxable investor cares very much about getting long-term capital rates, about deferring income, not getting double taxed, although they're somewhat flexible there. And they really don't like phantom income. Well, no one really does, but they have it worse than the other investors who often wouldn't be taxed on the phantom income amounts in the first place. There are your super tax exempts. These are state entities like CalPERS, which are just exempt from tax. They're just full stop, have wonderful lives, and the rest of us envy them. So you just want to make sure that there's no corporations in their way, really, that'll accidentally give them a tax where they didn't have to pay one. Next, you're going to have your tax exempts. I said avoid double taxation as the first one, but then I turn around and note that what they really don't like is UBIT. They don't like unrelated business income tax. If any of you are not familiar, it's just income from a business that's unrelated to the tax-exempt purpose. Most passive income gets an exemption and will not be UBIT, but if they're invested directly in an operating partnership, that income is usually going to be UBIT. They do not want to see that. They're afraid that it'll bust their tax exemption. Usually that won't really happen, but it's part of what they're worried about. An interesting thing there, if you don't practice much with tax exempts, is that debt-financed income is automatically UBIT. So it's it's an exception to the exception. So I said that, passive income, generally exempt from being UBIT. An exception to that is passive income financed with debt. So you're going to have to think about that with some partnerships that are, some funds that are leveraged. Next, you're going to have your foreign investors. They do not like to file U.S. tax returns. it's kind of nice in general to not be on the IRS's radar. So they're very wise actually in this regard. But really, this just means avoid ECI. Similarly, avoid branch profits. The two kind of go hand in hand. So just avoid that. And lastly, you have your sovereign investors. These guys do not want commercial activities income, and I'll discuss a little bit more why after going through the other guys a little bit more. So what sort of structuring do you need to do to achieve this? So for the U.S. taxable to get favorable rates, usually this just means paying attention to holding periods. You to get them to get long-term capital gains, you have to hold things for a year. To get, qualified small business stock, you have to hold that for 5 years, or for both cases, you can use rollovers and extend your holding periods, or your just general sort of carryover basis. This actually means that they have some conflicts with your other investors. So other investors are happy to just dump an investment as soon as you get it, right? They don't care about the special rates for the most part. The foreign investors could, but generally they're going to have a blocker in the way. So, that being a corporation, you're going to be stuck at the 35% tax no matter what. So this is a unique feature of the U.S. taxable investor for the most part. They don't like passive foreign investment companies as a vehicle. They just add complexity to their planning. I believe we'll be discussing PFIX a little bit later when Roger and Fiona are up, so I will leave that for then. For the super tax exempt, this one's pretty straightforward. Just get them their money. Don't get a corporation in the way. They don't care for losses. That's the other flip side. It doesn't really matter, right? If they're not going to be taxed, it's not that great to get a deduction. It's just sort of the nature of the beast, which means that if you have a way of monetizing your losses, trapping it in a corporation and flipping it without without it being totally worthless under 382 in that area, that's something that they might actually appreciate. But then, again, that's sort of offset by the fact that they don't want corporations in the way most of the time. For the tax exempt, to avoid UBIT, basically you're going to want to use a blocker. Otherwise, they're sort of similar with the monetization of NOLs that I just mentioned. And I'll discuss the how you avoid UBIT when I discuss ECI. The two are very similar tax systems, actually. So for the foreign investor, to avoid their U.S. tax filing obligation, they just shouldn't have ECI. For those of you who aren't familiar with ECI, this is effectively connected income. That is income that is effectively connected to a U.S. trade or business that they directly own or have an agent own, and that sort of thing. ECI will usually show up in a fund situation if you have an investment in a pass-through or the fund itself has a trade or business. Otherwise, you generally will not have this issue. And one other important one, FERPTA. FERPTA is a rather important one, actually. If they have U.S. real property interests, selling that is going to generate ECI automatically. There's going to be special withholding regime that they're going to be under. So that's something to plan for as well. Most funds, however, do not have the problem of having ECI. A venture capital fund that invests solely in C corporations are not going to be generating ECI. This is because the sort of trading or activities that the VC fund itself will do is exempt under this 864B2 trading safe harbor. So if you have ECI, the primary solution for foreign companies is to have a corporate blocker. You guys, I'll show that to you a little later, but I'm sure you guys are largely familiar with it. You're just going to have them own their investment through an intermediary U.S. corporation. That'll just move the filing obligation down to the U.S. corporation, but it will also, they lose their long-term capital gains rates, and there is some treaty planning that you might lose, but by and large, they just prefer to stay out of the U.S. tax system anyway. If you have a blocker, remember you can capitalize it with debt. You can get the money out tax-free. I think this will be covered in our international presentation using, you'll have to use a treaty usually in that situation. But you have to remember the rules that target earnings stripping and also some other regulations as well. There are other solutions you can do. Again, you can use treaties to avoid having ECI, or you can split the fund to have sort of a foreign fund and a U.S. fund and do some other planning, which I'll discuss a little bit when I discuss lending. So for the sovereign investor, they and their wholly owned entities that are within the that are organized in the actual sovereign's state, they're going to be tax exempt as long as they don't have commercial activities income. No one knows what commercial activities income is, but we know what it isn't. It's passive investment will not make the cut as commercial activity income. If they do have commercial activities income, it can taint their income and actually give them taxation where you might have not otherwise had it. Another interesting thing that pops up is any of their wholly owned entities, and this actually is true for super tax exempts as well, are going to be corporations. You can't use check the box. So do not accidentally make the mistake of creating a corporation that you thought was a pass-through entity because it was wholly owned by CalPERS, or by Russia, for instance. So now that I've gone through sort of the investor types and their preferences in a little bit more detail, I'm going to go through some of the different kinds of investment that these companies pursue and how they, why they pursue them, and a little bit more on how you should structure them. So one thing that I've heard about and would like to get to try out someday, but haven't really seen, are funds that will actually invest directly into partnerships. They will not use a blocker. They will just deal with the fact that it's going to be a complicated, painful tax process in the hope that it will get them a better rate of return. So far, I haven't really seen this in VC funds, which is mostly where I end up doing work. They prefer corporations pretty heavily, but if you do have a fund that allows this, the common structure is apparently to allow to let investors choose whether to use a blocker. So they get to pick their poison. The advantages of this is obvious. We all know this as people who work in tax. Having only one layer of tax is a great thing. Being able to sell assets directly is going to net you extra money over selling the equity. That is, corporate equity. Losses will flow through, although you're not going to probably use these losses as investors. There'll be passive activity losses. And they have very good exits. If you're going to have a taxable exit, a partnership just gives you a lot more leeway and a lot more tricks. And I've noted some of them on the board. The disadvantages of flowing through a partnership are sort of what I've been indicating as I've talked about, ECI and UBTI. Investors don't want this. This adds complexity. They're going to have a bunch of K1s and also perhaps some state income tax filing obligations that they're not going to be so happy to deal with. There's also going to be recapture income. And actually probably the most important one that comes up for a partnership in general is that on the downside, whenever you have a company doing really poorly and getting a lot of COD income, you're not going to really be able to do anything with that, or you're not going to be able to use the exceptions to COD income that would otherwise reduce your taxation, because COD income, you look at the partner level to determine if they're insolvent or not. This is in contrast to a corporation. We're going to look at the corporation itself to determine insolvency or bankruptcy. So here's an example of one way to structure with a blocker for the pass-through organization. So if you guys haven't seen it visually, this is one way to do it. The GP in this situation is taking carries from separate funds, and alternate investment vehicles. The sensitive investors, that is sensitive to the problems of ECI and other complexities of flow-through taxation, coming through a blocker. The investors who are happy to just deal with the complexities of a pass-through just come in directly through the fund, which is investing in this operating pass-through. So for ordinary income assets, you're going to have your own set of complications. Ordinary income assets will generate capital loss in a lot of situations. So for funds that invest in loans, for instance, a lending fund, they're going to be getting ordinary income on the upside, and they're going to be getting capital loss on the downside. So that's kind of a problem. That's honestly just a problem that a lot of the time you just kind of have to deal with. But for loans, since you'll often be foreclosing on something or getting some security interest, that'll at least prevent it so you don't just have to ditch the asset and get a capital loss up front. At least you have another asset to deal with. Some funds can use a mark-to-market election, and they'll be able to just sort of net all their income. Particularly interesting funds that I've been seeing more of are those that do lending. This creates a couple unique issues. The big issue here is that the fund itself is going to be a trader business. The IRS has at least stated in some CCAs that they believe this to be the case. It seems to be pretty agreed to. That lending itself is not, it's not trading. It's not under the safe harbor. You're pretty much involved in a financing business. So in this situation, you're going to generate, so I'll go with the bottom point first. You're going to be generating ECI and UBIT to people who invest directly into the fund itself. There's a couple things you can do with that. What a lot of these funds will do is the season and sell strategy. They will, they'll have one entity doing the loans, they'll hold on to it, and then they'll sell some of those loans over to a foreign fund, for instance. And the idea there is that there should be enough decoupling between the two of them that the fund that is buying the loans is at least formally not involved in a lending business. It's just going to be trading loans. You're also going to be able to use treaties, and there's also one other trick I'll show you a little later on that you could use in this situation. Mortgages have some particularly interesting issues here. Interesting in the sense that I don't know how many people run into them otherwise. The taxable mortgage pool rules are, pretty complex, and you don't see them very often. Obviously, you pretty much have to work with a company that does a lot of work with mortgages to even get them to come up. But if you have someone who's doing lending, who has a pool of mortgages, and they are taking debt in from outside investors, so they have like asset liabilities, and they have liabilities they owe to other investors. If they have too close of a relation, essentially, the entity is forced to be a corporation. So if you don't plan for that, you can get yourself into trouble. If you really can't plan your way out of it, you probably have to make a REMIC or something else that most of us do not have to practice in, luckily. So we've got also another interesting set of investments come up for venture capital. You'll see a lot of 305 issues, if you pay attention to them. You'll see payment in kind stock. All these come from different sort of preferred stock or convertible instruments that have been in vogue at one point or another, or sometimes still very common. Payment in kind dividends, so preferred stock that'll be paying out other stock, will trigger 305. They're probably going to be taxable stock dividends under 305B. If you change your conversion ratio, you're going to have to watch for a 305C and a deemed stock dividend, and you're going to have some unreasonable redemption premiums, although you can plan for these pretty well. The rules are pretty clear-cut. So the other thing that you're going to see very often is a lot of warrants in any sort of venture capital deal. You should always, redeem your warrants. You should not exercise them. This is because, for whatever reason, warrants do not have a tax holding period, whereas convertible debt typically will. You can recap, and you can have a carryover holding period in certain recapitalization scenarios, or at least that's what people seem to believe. But warrants themselves explicitly do not carry over their holding period when exercised. The exception to this, of course, is going to be a penny warrant, which I'll discuss at the same time I discuss some of the new alternative equity derivatives that we're seeing more of. For those of you who don't know, it's very common for startup companies to use safes or KISSes, although I really only hear safes, and I like the name maybe a little more. But it's the safe alternative for future equity and the keep it simple security. It's not entirely clear what it is for tax purposes, but to me it seems it's pretty much a warrant or a penny warrant are the only real comparisons I think make sense. I don't really think of it. It doesn't have very many debt-like features. It does have some, but I think out of the comparisons, this is probably the closest one. So penny warrants, that is any warrant, you're gonna, where the chance of exercise is pretty much guaranteed. That's gonna be equity from day one. There's some revenue rulings to that effect, and that's gonna be the case generally for these kind of these instruments. If there is an exercise price or they're not otherwise not likely to be exercised, there'll be a warrant, and otherwise I really just don't see it being convertible debt. There is some uncertainty here, but that's I think going to be the likely tax treatment. Another thing you're going to want to consider is for VC funds is the qualified small business stock rule. I think you guys are all going to be familiar with the general basics. You need the right small enough corporation to make this work, and it needs to be done on original issuance. When you have a fund situation, you should remember that varying interests in the fund are going to sort of make you lose some of your qualified small business stock. You can't transfer your interest in a partnership that has qualified small business stock, and the recipient can't expect to get qualified small business stock later. The regulations are to that effect, and that's sort of in keeping with, preventing you from getting around the original issuance requirements. I think, this is something that I would like to try in the future. Haven't got a chance to do this one yet. So you all are familiar with the rollover of Section 1045. That is, once you have qualified small business stock for 6 months, you can sell it, and you can move this your cash into another small corporation, and it'll roll over. You'll also get to tag your holding period for purposes of 1202 qualified small business stock. It's kind of a pain. You need to identify your follow-up small business very quickly. And this is probably not as big of a problem for VC funds, because these are very often going to have a lot of investments around the corner. But I think for other people, this is going to be more of a problem. One thing I've been playing with, hopefully I'll see if it works, is that you could use the reorg provisions, which allow a company that is not otherwise a qualified small business to have qualified small business stock if there's a reorganization of a qualified small business into that entity. So I think there's actually probably some room to argue that you can make an S-corp with qualified small business stock. We'll see if I get that one to go and get to try it out. But I think that's one that not enough people have tried out. So moving on, here's another structure that I think has quite a few tax advantages if you're working with a fund that has high cash flow and very predictable cash flow, like a lending fund, for instance. So on this one, what we have, and actually this is also, there's a couple things about this that are nice. For reasons I'll explain. This should allow you to avoid state tax, and it should allow you to reduce your international tax. The idea here is that the main fund is going to be, it's going to invest directly in these instruments that have regular, predictable cash flow. And certain investors who are not going to be able to plan out of the withholding tax or state tax are just going to invest directly through this fund that holds these assets. The other investors that are sensitive are going to invest in this outside fund that will just occasionally make big debt investments in the main fund. Now, you don't want this to create a lending business, because then you might have ECI in the sensitive investors fund, and that might make this whole thing sort of for naught. But what this ends up doing is a couple things. Although it's really not that crazy of a structure, it has some favorable features. So, for instance, if the sensitive investors fund had a direct partnership interest in this main fund, it would get. So, say these investors in the top right here. I'll use this pointer. Are out of state, and this has a California effectively connected income business down here that has regular, or not effectively connected income, just a California source business down here. Under California rules, the California source income is going to flow up. So we have this California business earning this income. Now, on the other hand, debt doesn't flow up. Debt is going to be sourced as an intangible. under the California rules. So this could get an investor out of the California tax regime who otherwise would be in the regime, which is not a bad feature. Another thing that you can do here is that these sensitive investors who are foreign can use this to, you'll have debt. You're going to be able to get out of U.S. withholding tax in most situations, although, of course, you're going to have to plan for that. Though you should be careful to consider this, make sure you don't have any conduits happening, which I think is one potential issue.
So that would be where you try and structure all of that as portfolio debt, minding not creating a lending business, because otherwise it's withholding tax-free from the end state.
Yeah, exactly.
As long as you do your factoring.
Yeah, as long as you do it right. Yeah, that would be the hope. So this last slide, I guess I'm flying through this much faster than I did when I ran through it on my own, but we'll just discuss for a moment. The more liquid funds have some interesting things that you should keep in mind for those of you who don't practice in the area. I'll start on the bottom, which is the publicly traded partnership rules. If you allow for regular enough withdrawals, so you have a very liquid partnership, so you could withdraw any day and just get your income right out, there's an argument that this, if an exception doesn't apply, that this could be a publicly traded partnership. Now, most partnerships, this will never be an issue because you're going to have less than 100 partners, so you won't even really need to think about it. The other exception you might have here is the qualifying income exception, so a lot of funds will have that. Most kinds of passive income are going to, if you have a partnership, I believe it's 90% or more of the income is qualifying income. I think it's gross income. It's going to still be taxed as a partnership. For those of you who don't know, the general rule of a publicly traded partnership is it's taxed as a corporation, and kind of a bummer if you didn't see it coming. The other thing you can do is control your liquidity, and you're going to see this very often in more liquid funds. They're going to have rules that say, you can only withdraw quarterly with enough notice. That's done. It's partly nice, for the sponsors. They're not going to want to have to give you that money that often. But it also is done to avoid this publicly traded partnership issue. Another thing you're going to see in more liquid funds during a withdrawal is you can have sort of a pseudo double tax, which normally in smaller partnerships is alleviated by 754. But if you have more investors, you're not going to be able to really do 754 it's going to be a rather difficult administrative nightmare. That is, say someone comes in, puts in a $100 investment, that investment appreciates to $500, but none of that, most of that investment, that $400 of appreciation is in the form of unrealized gain. So what you have to do is, if they withdraw that next year, you're going to give them that $500 of cash. They're going to have $400. No, excuse me. Let's say it's all unrealized somehow, and there's just cash sitting around. So they're going to have $400 of gain on the way out, right? Their basis was $100, and they're getting $500 payout, and they've not gotten any allocations of income prior. So normally that's going to be, if there's a 754 election in effect, you're going to use that to step up your basis. So that's one way of making sure there's no problem. But what will happen, so if there is no 754 election, you're going to have sort of not really a double tax, but it'll feel like one. The other investors will still be allocated income later on that otherwise would have been allocated to this guy. Of course, they're going to be able to, their basis will be stepped up in their partnership interest. So later when they exit, they'll get the benefit of their payment. But, we may have converted our income, we may have converted from an ordinary loss, if you will, to a capital loss. And we've also delayed our recognition of this loss for the remaining investors. So again, the main way that you fix this problem in an operating partnership is a 754 election. You're just going to have the other partners appropriately get a step up in the basis of the remaining assets. Hedge funds love stuffing, which is where you just do allocations of income. You basically special allocations of whatever income there is in order to not have any gain on the payout. Basically, you're making it as though they got only taxable income, and then they got paid out the corresponding amount. There's some concerns as to whether or not that's okay under the partnership rules, but people do it anyway, so and it's your own preference at that point. If you've got regular cash flow and you know that they're going to be cashed out maybe in the next year or so, you could just force them to withdraw over a long enough time under 736A, and that's another way to handle this. And another thing is securities partnerships can sort of easily adjust their asset bases accordingly without needing to worry about all the minutia of 754 elections. That's actually all I have. So if you guys have any questions, I'd be happy to answer some, or we can take a break.
Can I follow up on the portfolio bit?
Mm-hmm.
I mentioned earlier I'm on the international side, so I see a lot of foreign investors, right? And you end up with convertible debt. Here you said true debt. I'm assuming that's straight debt and convertible.
Mm-hmm.
And then, once you get past a certain percentage, 10% voting control,
Mm-hmm.
you lose the portfolio designation. And I've seen a couple of situations where on conversion, they've triggered the more than 10%. And and I'm not sure this is really addressed, so I'm really asking your opinion here. In a situation where on conversion, that debt investor, would have more than 10%, are you treating the interest as qualifying portfolio interest? Something you haven't really worked through.
On a convertible situation?
Yeah.
I've not worked through a convertible situation on this particular one. So I'm not entirely sure. I guess if you can see it coming, you could always do that, that particular structure where they divvy up control in order to still allow for it. But yeah, that's only if you see it coming. But yeah, I've not run into that situation, so I've been lucky enough not to have to figure that one out. Anyone else have any questions? No. All right. Well, thank you for your time.